And a couple of our principals are here in the audience to heckle me. The least I can do is introduce everybody, but I posed a few questions to our panel before we arrived, and we're going to talk for a little bit and then take questions, Q&A from the audience. If you have something that inspires you that you want to interject, please raise your hand and we'll sort of create this discussion based on what everybody in the audience wants to hear. So without further ado.
Literally, it's not on. Yeah, I'm Mark Evans, and I am an angel investor, having come most recently out of the SaaS world and the marketing agency world, and have done about 12 investments over the past 3 years, and that's been over a variety of different industries, which kind of surprised me when I look back on my portfolio. So with that, I'll turn it over.
I'm Andrew McGregor. I run a small family office with my partner, who is a millennial. And my background is really in one of those companies you talked about earlier, which was scaling. So both here and in Europe, 20 million to 1.5 billion, 5,500 people. Innovation was a constant problem, but we were able to get at least some acknowledgement when we'd have things like the best consumer product in the last 100 years.
Hi, I'm David Odom, and I've been in the venture investment space for over 15 years with kind of an unusual background across multiple platforms, all with a strategic venture investment bent, having deep relationships with strategic partners, as well as an unusual fund vehicle for the Department of Defense that was investing out of all the SBIR programs coming out of the Army, and invested in or directed capital to over 100 companies through that platform alone. Now I'm involved in launching a new investment platform here in Colorado, and I'm really excited about that. I'm also involved with a number of university systems, and most recently investor in residence with Texas Tech University. And in my spare time, I am a competitive bike racer, road racing and cyclocross.
Hi, I'm Kirk Holland with Access Venture Partners. We're a locally based venture capital firm focusing on early growth companies. Like David, I'm a survivor of the tech venture business for about 18 years now, first in Silicon Valley and now out here. In the last 15 years, we've invested in about 70 Colorado-based companies and have been fortunate enough to work with some great entrepreneurs and companies like Inspirato. I always advertise for my companies on these things. Rally Software, Logarithm, Craftsy. So it's been a pleasure to see this ecosystem in Colorado go from where it was back when I moved here in '02 to where it is today, and for the future to come. Pretty excited.
So one of the first questions I posed to everybody last week was, as an angel or as a venture capitalist, do you have a mindset towards an early exit or a decision matrix already defined when you make an investment into a company, so that you know when that event is triggered and you want to exit early? So, start with you.
Sure. So from my perspective, looking at different investment opportunities that come across, occasionally you will find something that is geared very well toward an early exit. Most of the time, you're looking at something that is, especially at the angel stage, it's a real proto business, and it's so early, it's very difficult to say that there's going to be an exit. You can always say, well, somebody ought to buy you. These people are logical buyers of you. You can almost always find that. But the question is, will the stars align? So I do not have a particular filter or framework. The one thing that's kind of an interesting thing from an angel's perspective is how you invest from a tax perspective. If you have a bunch of early wins and you are not investing through a tax-deferred vehicle, that has an impact. So a fund, on the other hand, would not necessarily have that. So that's one aspect from an angel that you might consider. But I personally don't have that, and I'm curious to hear what other people have.
You know, and Andrew, why don't you also talk a little bit about maybe the difference between your investment philosophy and the management or ownership of the company you're investing in and the early exit perspective?
Absolutely. It's one of the things we look at really critically. We do have a bias toward early exit. That's kind of our starting position. But we move off of that based on management. So one of the key things we're always looking for in the old saying, team, market, product, then we would say exit. But we've invested in a number of companies here that really based on the competence of the team and the clarity with which they had alignment on what their exit plan was, okay? What we shy away from is when we're talking to someone and they think they're going to always beat that 1% that goes from startup to IPO. Big red flag.
So, it's coming from a venture perspective, which is most of my perspective, the firms and the platforms I've been involved with do not have necessarily a preference for early exits. I think, and this is one of the bifurcations in quote unquote the classic angel versus venture model maybe, but, we're looking at that classic prototypical story for high growth that creates value and disrupts a large market. Now having said that, we also are quite aware of the realities of how most exits happen, and they're mostly trade sales, and they often end up being with a strategic acquirer and how they think about valuation of those things. But I've never been involved in transaction where we think about that because. And I think we'll get into this a little bit more in the discussion is, from my perspective, it can become a limiter in how you start optimizing for the business. I mean, most businesses have some optionality in them. Hey, along the way, we create enough value or hit enough of an inflection point. Yes, of course, there'll be acquisitive interest in this, and we can consider that when the time comes and if the boards align and a bunch of other stars come together. But we're not going to stop pushing for the bigger story. So anyway, that's at least from my perspective.
Not surprisingly, my perspective is pretty similar to David. Our vehicles, to be specific, not to bore you with legal mumbo jumbo, but our funds have a legal life of 12 to 13 years, and if you look at the studies over history, they end up being more like 15, 16, 17-year vehicles. So our investors give us their money because they're looking for outsized returns, 5 to 10% better than the public markets, and in order to do that, at least from my experience of doing this for 18 years at the early stage, you've got to have an outlier or two or three if you're really lucky in your fund, otherwise you'll be out of business and you won't be a venture capitalist anymore. So our philosophy is more around exit values and multiples, but if you look at the data, it takes a long time to build a valuable business. You may get lucky and get sold really quick and make a nice return, but we can't have an investment strategy that's relying on too much luck. We got to have some luck, but not all luck.
So what's the discussion like with the management team when that opportunity comes along for your VC orientation?
When an exit opportunity comes along, yeah, it's interesting. I was thinking about it before this panel. I'm very torn personally and professionally, because professionally, for the job my investors expect me to do, which is go out and generate 20 to 30% annual returns, that early exit where you make a smaller multiple is tough. But at the same time, I love to see entrepreneurs make a lot of money, put it in the bank early in their careers, and then they can go take risks for another 30 years and I can back them later. So my principle in the business since I've been doing it is never stand in the way of the early exit if that's kind of what the team wants to do, if that's what the entrepreneur wants to do. But in all honesty, for my business model and how I'm rewarded and my expectations, it doesn't move the needle that much. But I'm open to it and support it when that's what the entrepreneur wants.
Well, I without airing too much dirty laundry from these kind of discussions in the boardroom, I mean, there's a real tension potentially, and it goes beyond just the fundamental venture model, it also goes into things like where are your investors at in the life cycle of their fund, and a few other things. And so you get competing interests with the founders and even different investor representatives at the board when these types of, quote, early exits are presented, and then you factor in, well, how much more capital has to come in, what's the likelihood of the company raising that capital, and what does that mean from our exit risk? So it's actually quite a complex set of events, and particularly when these opportunities present themselves kind of out of nowhere, and you maybe have a time, window to react to them. So I think it can get quite complicated.
Yeah. One of the things I'd say is we try to look quite in depth at the management team and what their own maturity is. Do they understand what it's going to take if they scale up from 7 to 25 to 50 people? And so we don't really have a preference on what we want to pursue within that company. We want them to get aligned with the right investor set. So they need the right investors on the board. They need the right participants in their organization. We just need to make our own decision whether we're the right match for them.
So Mark, what is that conversation like with an early larval stage company, and you set out the parameters of why you're investing and what are the milestones? What do you set in motion in terms of your decision matrix for adding money? When is the valuation right? When is the exit opportunity something you consider, et cetera? So talk a little bit about that early on process.
I'd actually have to step back even a further step, and I would ask the room, you don't have to raise your hands, but how many people in here are angel investors? And if we tried to say, who has, what are your objectives as an angel? They would be very different than, as I think Kirk kind of crystallized it when he said, look, if you don't do this well, you are not going to be in the venture capital business. You have to return for a fund, and angels don't necessarily operate like that. Some people may be incredibly financially focused. Some people may use it as more of a philanthropic venture. Some people may say, hey, I like helping build a community, and I like helping young people succeed. I want to have fun. There are so many different objectives. So for me personally, I got into angel investing for I won't say non-financial reasons, but the financial return was not a singular primary driver. And I got involved in a way that was tax deferred. So I don't know, again, for angels out here, how many angels, I'm curious, invest through either a solo 401k or a checkbook IRA, self-directed IRA? So a couple of people. Should you? I am not an attorney. I am not a tax advisor. You can talk to me later about that, because I do know something about that. But that, by definition, if you're investing angel funds in a retirement portfolio, you have a fairly long kind of time horizon. So I think there are many reasons why you might be an angel investor. And the idea of getting together with any of the 7 or so companies that we're presenting today, for example, one of which I've invested in and others I've looked at. Boy, I think he was well said when he said we really focus on this as a criterion for our activity and our involvement. But I have not looked at that. I've been open to much more serendipity rather than having a focused approach. So for me, when the option comes up of having that conversation, I mean, first off, I'm a tiny investor in the grand scheme of the cap table. So I am not going to dictate to the entrepreneur, well, I know you'd like to exit, but that's not going to happen under my watch. It's just not going to happen. Instead, it's much more kind of philosophically, hey, look, if this is the right thing to do, how can I be helpful? And I'll probably do okay from it. And fortunately or unfortunately, my career is not riding on the outcome of this, because it's a personal set of investment. So sorry to talk so long, but that's my perspective part of this.
So Dave, weigh in a little bit. You're usually a little later stage in the VC from the angel perspective?
Well, actually, not quite, actually. And it's interesting, as I think about some of the new platform that I'm looking at, it's actually much closer to the angel community. And I think there's a couple things to think about. I've spent the last year and a half actually really engaging with the angel community in a way that was different than when I was sitting at the other side of a transaction, in a Series A investment, possibly, to kind of understand the dynamics, the incentives, also involved with helping, for example, Texas Tech establish their angel fund and kind of getting more into that community, because I think there's some interesting opportunities because of the fact that it is true, it takes less capital to start a company today. And the dollar amounts that are necessary to do that, blur the lines, and I think the new Series A is, the $1.25 to $1.5 million. Well, all of a sudden, you're not that far away from a couple of angels syndicating to do that if they wanted, or an institutional quote unquote. But the thing that I think about when presented with this idea is, one important thing is whether you're focusing on an early exit, whether you're thinking about it, whether you're pre-planning it, or you're going for the whole thing, the fundamental risk is no different. If I'm trying to build a new product or technology or service, the risk doesn't change because I said that. I can say it a lot. I say, I'm going to do an early exit. That's great. And so if I was presented with two investment opportunities that had the choice between optimizing, and maybe they don't optimize, but let's say they optimize around an early exit, raise less capital potentially, or run leaner, I think that could actually be a riskier opportunity than one where you actually are going for a larger opportunity. And I was saying this earlier, I think about it like you hop in a plane on a trans-global, and you've only got 5 landing stations to refuel. Whether you're 100 foot short of the runway or 200 miles, you still crash. And so I think there's something to think about the financing, which was one of the top 2 risk killers for new opportunities.
I don't know if this goes to your question, Fred, but I got to thinking about it when Mark was talking. I mean, I like to say controversial things on panels, but, if you're an angel, I mean, he defined a lot of reasons to be an angel, and I think it's much better to be an angel for a lot of the non-financial reasons, because if you're focused on just the financial reasons, it's a tough row. I always tell them, whatever you would take to Vegas this year for a week-long trip and gamble, that's probably what you should allocate to angel investing. And basically,
All right, guys.
I hope you should get something non-financial out of it, because, and then to further, well, let me give you a hint of how to get some financial out of it. I'm biased because I've been doing the venture model for so many years, is that I think if you're investing, we talked about this over the weekend on the phone call, it's like if your investment strategy is that you think you're going to drive early exits that are kind of 2 to 4x multiples, just do the math. I mean, if you pick 20 deals, you're going to have half of them, you're going to get a 0, and maybe you're going to get, 3, 4, 5 of them are going to be 2 to 4x, you're going to break even. So, I guess when it comes to early exit, I think the best, and it's said on a panel earlier before, it's like you got to look at the situation. Look at what the offer is. Mainly, like I said, leave it to the entrepreneur, the person that knows the most about the market and the company and what the future prospects are. Weight their opinion much more heavily and make the decision. But sorry, I just had to give my warning that if anyone's trying to develop an angel strategy that's early exit and I'm going to make a lot of money, I think it's flawed.
Well, stay with it for a second here, because
I figured I could stay on that.
you want to talk about early exit. I think you're done for the day. So continue on a little bit, because you talk about some of the dynamics of the legal structure that VCs have versus angels, and I don't think everybody's really aware why you have Access Venture Partners 1, 7, 12, 15. So you have some rules and some structure to it. But comment a little bit on that, as well as the form of the early exit. When do you say that's not the right kind of early exit? Either who's buying it, what I'm getting in return for it, I'm not being cashed out, I'm getting stock, or there's some structural issues. So talk a little bit about sort of your parameters, but also the form of the early exit.
Okay, where do we start on that one? It's just more specifics on the venture fund. We're all structured the same. They're 10-year partnerships with 3 one-year extensions. We have to pick all our companies within the first 5 years, so that last company you pick is year 5, and you've got year 13. So we have long horizons, which is one of the good things about venture capital as money. We're very patient. We're looking to build companies over the long term. We're not pushing for a short exit. So those are the structural issues and how we invest. In terms of the decision-making of early exits, man, I have lots of stories. Feld and I were talking about this the other day. Lots of stories of, that board and those entrepreneurs were so stupid. They had the $200 million offer and they passed, and then 5 years later you shut the company down. There's lots of those stories, and then there's just lots of plenty of other stories. We have some great companies, like Logarithm or Craftsy. I think Dave DuPont said it earlier. He said, I have my formula of what is the round that I just raised, what's the valuation, to be taken out, it has to be a multiple of that because I think I'm going to grow through it. So it really comes down to some analytics and then some gut feel of what do we think the future holds for this company. And to be specific for us, like I said, our investors expect, call it 20, 25% IRR. If we're sitting there, we could sell and we could make, 25% IRR on that particular time. But we strongly believe if we sell here, we can make 35% IRR or 50% IRR. We're probably going to vote to keep going.
Gotcha.
I like to talk about those limitations because I'll probably take a different view. How many people here are entrepreneurs, honestly? Okay? Would you like to have the call when you exit, or would you like him to have the call when you exit? Okay? I really believe that if you're investing behind a management team and behind a market penetration idea, you want to be lined up. And I don't want to be spending time renegotiating with them continuously when we could be spending our time negotiating with a strategic buyer. That's really an option call. For others, they're clear about wanting to go that direction. I think it's great. I like to invest in the other side.
Well, I think there's an interesting other, and I said I was going to say there are a lot of issues that transcend whether you're a VC or an angel that play into this, but yet I'm falling into the VC persona trap here. But the other dynamic about the time component, which is the IRR, right, where on platforms I've been involved with, we've had fantastic IRRs from a quote-unquote early exit. It was a strategic acquisition. On an absolute dollar amount, it wasn't the largest, but it was great. Here's the problem, though, is that one of the reasons that you don't see a lot of venture funds doing 100 investments, at 500K, because it's really hard to find great companies and the opportunity cost and the time. So there's another dynamic to this of trying to find opportunities. And even if you're doing early exits and that's your model, then you've got to go to 3 more times to kind of get the absolute dollars to make sense. So I think, that's something, important to consider. And then just to your, real quickly on the other point about, being part of the decision process for a quote unquote early exit, look, if a company came into see me, and the founder and CEO, his story was, hey, I've been 20 years in industry X, I was the VP of marketing sales, I know everybody, I know every customer in this industry, I know exactly this pain point in the marketplace, none of the legacy companies want to move on it, I'm going to go do it, I've got 3 other key guys, we'll turn it around in 3, in fact, I bet my next employer will buy us, and I have the relationship to start that. Well, that's a different story, right, that could make sense.
It is.
Mark, you've made some early stage investments recently. When do you go to the management team and say, hey guys, you're at that point where we either need to raise real big money or we need to look for our strategic options? When does that discussion happen, and what are the parameters that sort of light up at that point?
Well, I think from an angel investor's perspective, that varies greatly on your relationship with your portfolio companies. In the dozen that I have, there are a couple that I'm pretty close with where having that kind of conversation would be appropriate given my level of investment and my share of the cap table. And it's much more of a of a continuation of a role that I have with those companies where I'm just helping them with the strategy of the company or a particular operational issue. And so, unlike Andrew, who, for his model, takes the right approach saying, we will pick companies based on these set of criteria, hopefully finding exactly what Dave just described. If you're not focused on that particular model and you're just saying, look, I've got a number of people that I work with, some very closely, through the course of those conversations, you will come up with hopefully some ideas. And I guarantee that every one of the four of us, especially the guys who have been doing this for a long time, have had fantastic conversations of truly deep, significant strategic nature that has shifted the development of the company and its growth path through a partnership or an acquisition. So I don't think there's any obvious marker. I think serendipity plays such a huge role unless you find someone who is totally set up. And I've only worked with one company that's been like that. And by the way, that company got sideswiped by a complete outlier factor that knocked them off their current path and put them on a second path. They'll have the same outcome, but there will be no angel investors involved in that because it killed the conversations of raising money. So it's the best things, you can be set up the best way and something can knock the wind out of your sails, and you just try to keep going. And they have persevered and will do well.
How many entrepreneurs out here are building their company for early exit purposefully? Anyone?
1, 2.
I mean, Mark just made a comment. I think he said you've only seen one. And I went early in my career where I remember a partner meeting, oh, we should do this one because it's really teed up to be an early exit and we need DPI to show to raise our next fund. Lo and behold, that was like the second to the last one to get out in our fund. So I come back to just predict, just like I said, angels can't predict exits. Entrepreneurs can't either. Steve Halstead, who's a mentor of mine, he's kind of the grandfather of venture capital here in Colorado, had a great saying. He says, build your company like you'll own it forever or you will.
Well, that's absolutely true. By the
How
way,
do you follow that up?
and what's interesting is when I think about some of the perspective I have in dealing with less traditional venture scale companies, as I'll call them, particularly through this unique vehicle I mentioned, this commercialization fund. All of these companies were kind of DoD aligned, still had commercial markets, and they were all looking at strategic engagements in some form or fashion with the ecosystem, so a Lockheed, a Boeing, et cetera. And one of the things that if I think about a traditional venture investment, I would generally steer an early stage company from taking investment dollars from a strategic at the earliest points because it tends to not work out well. And I've seen that play out personally in many cases because the misalignment of incentives between what the strategic really is seeking and what the prototype company is trying to do and still figure out can create problems, right? If I want you to build a blue one, but the market wants a green one, well, and you build the blue one, then you've just shortchanged the value of the company potentially. The other thing, though, that coming back to this fund, is that I have seen this challenge where at the earliest stages, engaging with a strategic can actually create some real risk in terms of leaking back what you're doing. And I was sharing this story earlier. A lot of times the founders would tell me, oh, I had this really bad experience with so they stole my ID. I'm like, oh, okay, yeah, but I'll tell you what, I firsthand saw that, not as direct, but outmaneuvering the companies and getting in front of things to optimize the situation so that they could potentially pay a better value or block a young company from sales and have negotiating leverage. I don't think it happens that often, but my point is there's risk in engaging with a strategic early, which I think is actually kind of important to bring risk reduction in this kind of early exit model if in fact it's a strategic exit.
Now, I would talk about seeking to target early exit, but not ruling out serendipity and seeing that if you have a really candid relationship with that management team, you're going to recommend that they go to a VC. You're going to help them qualify who that best fund is. Now, I expect to earn that level of trust with each of the people we mentor. I have a problem when they tell me my partner's smarter and better looking than I am. that's a little too candid, but if they believe we're really working in their best interest and we're bringing not just our talent, but other talent, we shouldn't flinch at all making that recommendation to hand them over.
So early exit isn't just getting bought, it's also potential public markets. Kirk, talk a little bit about how many companies have gone public and that was your exit as a fund.
Not very many.
And when they wanted to go public, did they go public when they wanted and the public markets were open, or was it fortunate?
A couple examples of yes and a couple examples of no. And it really, back to what I said before, in fact, we've got some companies that would love to go public, and I don't know if anybody's following the IPO market right now, but the window is completely shut. So, but it's funny, I said the same thing that I said earlier, is like, just keep building a great business. You're building a great business, and the exit or the IPO will come. I don't know if I call the IPO an early exit, though. I haven't looked at the data in a while, but I was thinking about it this morning. The last time I looked at it, on average in the U.S., it was like 9.5 years from first funding to M&A event, and it was like 11 years from, or maybe it was founding to M&A event, and then 11 years from founding the company to IPO. So on average, again, that's an average curve, but it takes a while to go build a $100-200 million revenue company to go public.
Actually, the PitchBook just put out their liquidity report for 2015, and actually they have I was a little shocked, they had the median at more like 4.5 to 5.1 years, but in general, I didn't see the bifurcation on IPO versus M&A, but. Is that from funding? That was from first round. Now, first round, is that institutional, is that, that's, I think, all in. My experience says exactly what you just said, unfortunately. And just when you think about the IPO, markets as well, I mean, from an investor perspective, I mean, there's risk in doing that. The last fund I was involved with had a very high profile exit in the battery technology space, and had a wonderful story at the initial placement, and we were fortunate because of actually we were not as large of an investor as others. We were actually able to get out early enough, and we actually had a nice return from that. Others were not so fortunate because once the markets cratered and the blackout dates and people started pumping, selling, all kinds of things can happen. So it's not necessarily the solution or the best path.
So what questions does the audience have? Nothing? They brought their checkbooks. That was a requirement.
Do you have a focus, or are you generalist?
Well, I'll just because I have a microphone. So I love that. So the fund platform I'm currently involved in is putting a focus on the health and wellness space in a very broad sense. Early stage investor, probably first institutional capital, and I love early stage investing, from my perspective, and I kind of embrace that risk. And I think, that when you think about that space, it takes a special character of team to be able to take that company and move through all the natural obstacles that are going to inevitably happen that neither of us can look in our crystal ball and say specifically, and it's really the team that rides through all of that. And so in terms of focus, I look heavily at the team, and many of the investments I've been involved in the past, known the team upwards of 6 months prior to making the investment.
So I think there's an interesting thing, because so many of you are entrepreneurs out here. Team is going to be the common theme among us, there's no doubt. That doesn't mean that you can be, hey, we have an all-star team and we're investing in potato farming in Antarctica. It's not going to work. Yeah. So you have some level of idea that's decent enough, and some ability to make that move to something different. I was shocked when I looked at my portfolio and kind of said, wow, I have a lot of life science investments. I would not have predicted that given my background. And I've moved more recently toward focusing on what I probably know better, which is SaaS and technology. But the things that have drawn me out of that have been mainly team leaders that I've said, that person or those people are just really good, and they will do right stuff. And the more you as an entrepreneur can get the skill building, the mentoring to be able to convey that, the more successful you will be, not only in raising money, but making your company a success.
I'll repeat that. The focus on team is key. Observe some teams, even though we weren't immediately interested in the company, and they convinced us. We've also looked at different spaces. We tend to back away from kind of digital advertising because we think there's so many people playing there and so much like life sciences, we like biomedical. I like things, I'm biased around things that are made. I understand global sourcing.
Yeah, we're generalists. I kind of call us old school generalists. We do everything, which is kind of fun. At least it stretches your brain. One partner meeting, I'm talking about knitting and quilting and crocheting regarding Craftsy, and then the next minute talking about, network security, so it's kind of fun. So we do, and we're regional. We focus here in our backyard, doing Series A. I'd say we're early and prefer kind of early growth, someone that has some customers and some revenue, so we can call them up and say, hey, you bought this stuff, you're not their cousin or their parent, or would you recommend it to their friends? So for us, it's a little bit later in terms of early growth is what we call it. That's what we invest in at Access.
Okay. Any other questions? Yes.
Question for Dave. Let's say that you invest in a company in year 4, and you've got a fantastic opportunity for the early. Buying the firm, do you reinvest?
Well, one, I wouldn't be probably investing at year 4 because of the usually wanting to get in very early, and so I would call 7 years in not an early exit. But regardless, so let's just call it I invest in year 1 and in year 3 or 4, what happens to the capital? Absolutely, you can look at reinvesting the capital, or you can look at There's a thing, there's an issue. Well, again, to get in the vagaries of a fund, but there's a concept called recycling fees, and so. And believe me, I actually have had the conversation and thought about this very notion of, could you look for an early exit to essentially redeploy capital that was originally used to pay management fees? And I would argue that's a good thing. I would look to do that in all cases because it actually increases the return theoretically for the fund. So that if that opportunity existed, I would redeploy the capital for that purpose.
Yeah, same answer, and we actually had it in our last 3 funds where we had, locally, we had Alchemy API, IBM came along. Literally, we invested in the first deal right when our fund closed, and a year and a half, 2 years later, IBM and bought an Alchemy API, and we recycled those funds, and we'll continue to do that for what David said. I mean, the venture is weird, we got a $50 million fund, call it, and if you don't manage your fund right, you might end up only investing 35, and your investors are paying you to go get returns on a $50 million investment vehicle, not a 35. So we're constantly doing that in our funds.
Yes.
What is the recent trend in capital funds
I haven't looked at the numbers in a while, and it's funny you said that lately they have, but to be honest with you, it doesn't mean shit, because it's all paper gains at this point. It's all the kind of frothiness write-ups that are going on in a lot of our portfolios. So my partner Frank says it I can't repeat it in public, but interim write-ups on paper don't mean anything, really. At the end of the day, we're trying to get cash back to our investors and get them a good return. Might help you raise your next fund and all that, but so I don't know the exact numbers. when it comes to venture performance, there's a few ones where the Kaufman report that says the venture model is broken, don't invest in venture, it's terrible. Well, any asset class that you look at averages, if I'm going to go invest in a public equity mutual fund, I want to try to pick the top quartile or top decile performer, and if I continue to do that, I'm going to do well, but I don't want to be in the average. And if you've been in the average of the venture asset class because it has such a higher beta, then it hasn't been a very good investment for you probably over the history of time relative to where you can make other money.
Yeah.
Is there any bias to
just my personal perspective is that I think there's actually, what's a little bit fund dependent, but my experience, it tends to gravitate more to business facing because there's a perception that there's in some ways less risk and vagaries of the consumer. I'll tell you, with the first consumer facing play that the fund I was last fall did, we learned a lot, it was not a positive experience in some ways because it went with the market cycles of the economy. Not that the business markets don't. So I've just found that some of these funds bifurcate on being more consumer-facing centric because I do think it takes a different kind of skill set and background to invest in those worlds. Even though I think it's gaining a lot more attention out there.
Yeah, I would agree with that, but instead of saying difference in funds, it's different in angels. I can look out in the group here and see some angels who I know are really geared toward one mindset or the other. And I would say that for me, I do the same exact thing and say, do I understand this? If I can understand it based on my history, I'll feel more comfortable investing in it. So it's if you're an entrepreneur, it's going to be who do you go after? How do you convince someone that your model is right? There's going to be some affinity.
I think one of the things that we actually do is rely heavily on Jacob Cordoba and the due diligence team here, and as Peter would say, the wisdom of crowd. We can turn and find people who may have extraordinary expertise in an area that we're wanting to pursue. We don't have to be self-sufficient, especially if we're syndicating. So we'll be careful about who it is we're listening to, what that advice is. We're very rigorous analytically in going through it, but we don't really have a bias. We do have a bias toward good data, yeah.
I think a company presented earlier on how to do good data. Somebody had a question? Yeah.
Shot. Oh boy, that's a hard one. I mean, it's really, all over the map. I mean, we have angels that we co-invest with literally from the very beginning because they view the investment strategy, they have a very similar investment strategy as we do. So what it was said earlier, but whatever you do, whoever you take money from, make sure you clearly communicate expectations around exits and all the other stuff with all your investors and board members and such. So but then I see your point where I think it is a good dynamic where you can have some angels that are willing to not kind of go for the grand slam or the home run, that are willing to get all these great companies off the ground. They deserve to get off the ground. They deserve to grow. They just don't grow fast enough for our model to invest in. And I always tell entrepreneurs, 99 out of 100 entrepreneurs at least, almost in the first meeting, I'm like, man, go do it. Go do it. Go build a great company. Put a couple $1 million a year into your family net worth. Have 20, 30 million bucks by the time you're 50 that is generational wealth, go do it, and do it without venture money. Don't do it with our money. It's the wrong money. So I do think it's a good ecosystem where you've got this kind of the angels seeding a lot of these things, getting them up and going, and when they become small plants, us guys can look at them and kind of go, yeah, that's the one plant that's growing really, really fast and fits our model. Let's now partner with the angel to take it to the next level. I think that works out great.
Comments? Kirk, you speak for the whole panel. That's, I'm getting it. We've got to be getting close to the end, aren't we? Any other questions? Yes.
You never resolved the math question. Argument against, he argued against angel investment. Right?
They wouldn't be here, so this would be a real weird panel.
Right for who? Right for who and right for what
How
motivation?
do you two, more specifically, how do you two resolve that math question that you brought up? What's one game basically set, right?
Well, I just said if you have an investment strategy, these are early, illiquid, high risk assets. So in order to do that, you've got to kind of have the outlier performers to drive some kind of IRR. And if you have a strategy that says, I'm going to only invest in companies, I'm going to drive a 1 to 2 to 4x in my portfolio of 20 investments, I don't think you're going to have positive returns. I mean, we have to report where our numbers are reported and Preqin and stuff. It's interesting. I don't think angel investors are.
I'm just saying the counter argument to it, I guess.
Well, I mean, we're looking at probably about 50 IRR if we can do that. We're looking at 3 to 5x if we can do that. We're looking at multiple companies, so we see it as a blended portfolio. And if I look at the data that says, 12% go to M&A and 1% go to IPO, and I look at having to hit to the long range, I'd rather not have to hit. I'd rather be able to choose to when I want to and have the blends otherwise. I can make that math work.
Well, I think if the thesis is, if I understand it correctly on early exits, is that there are a number of studies out there, and I've looked at a couple that I think are a bit dangerous in how they represent the information that suggest that, well, you know what, there are many opportunities for exits with multiples that can approach what a venture investor would like to achieve. It's, now what they all seem to leave out, in my opinion, is how many companies are zeros. And so of course, mathematically, there will have been exits that occurred with $2 million in, and they were bought at, yeah, of course. But the question is, what about all the ones that didn't make? And so as you as an investor, you don't have perfect knowledge of which is going to be that. And even if you had better knowledge, I still come back to this point, because I think there is opportunity for, I'm not saying there isn't. I think it's the right demographic to get into, but then you still have to chase a lot of those opportunities, and I suggest that's still hard to do.
Here's how I would approach it. I think there's two things. Number one, you've got a difference between VC and angel. Number two, you've got a difference between early exit and long exit. And by definition, if you want to make the math work and you say it's early exit, lower multiple, you have to have a higher expected value or a higher probability of the deal working, the company succeeding. So that's the only way you can make the math work. The reality for most angels is that if you want to do this and you want financial returns to be your number one goal, and you do 5 angel investments, that's really tough. This is portfolio theory, from Markowitz back in the 50s through 70s. It's diversification to get to the efficient frontier. Take that. A lot of problems with that. There are advances beyond that. But the reality is there are going to be a ton of companies that suck. Let me just restate.
Whoa! Not here, of course.
Companies that are not going to return well. From a financial perspective, they suck. Whatever.
So I think you see the difference between angel and VC right there. Right?
It's really a candid investment.
Yeah.
So I would, when I think about it, that's why I've tried to make so many investments, and I don't try to make big investments. I just said, wow, I'll try to achieve some of the financial goal by diversifying. I guarantee that I have picked companies that will not do well. I hope I get companies that do really well. When you have long-standing portfolios with 70 or 100 companies, you have a much better chance of hitting those home runs. But from an entrepreneur's perspective, it's much more the conversation and just trying to find an affinity with the person on the other side of the table. From an investor's perspective, you've got that, and you have to think about, well, will this money come back? And if finance is your single goal, it's a tough business. There are many other benefits to being an angel investor that I've found. It's a lot of fun. There's a lot of benefits, but anyway.
But by the way, I might argue against 70 to 100 because I think if you look at it, there's actually a ramp and then there's a plateau and then it begins to fall off again. Because the reality is there's only so many good opportunities at any moment in time in any given space. And so I maybe caution against that model of thinking, on it. So
Any angels that do 70 to 100, that would be impressive.
Good luck.
I just want to point out one thing about the math there is, we always say 10x return over 5 years. When you figure that out, that's about a 60% IRR. Half of them are going to go belly up, and you'll end up with perks 20 to 30. Now, if you're doing an early exit model, and you're doing a 4x over 3 years, guess what that comes out to for an IRR? About 60%. Half of those go belly up, you end up with a 2x. That's where the math comes to you. Work out as a strategy, and then of course you can. I think one thing is an angel can more easily recycle those funds because they're not limited by the 10 plus 1, 1, 1, and they're not limited by doing diligence that a fund isn't really set.
I'd ask a question. How many angels in the audience? How many of you all look at portfolios in your investment? I know one portfolio right here in a minute that isn't fessing up, but I think everybody tries to balance that out.
So we're right up against the time slot. Thank you very much for a lively debate. And they did bring all their checkbooks, so they'll be around the rest of the day. So thank you very much. Appreciate it. Thanks for my panel.
Thanks.
Thank you.
Yeah.